I want to share a story about a Wednesday morning that changed everything for a man named Gerald. Gerald is 69 years old and has been retired for about 3 years. His entire professional life was spent as a school district superintendent. 33 years of overseeing finances, managing staff compensation, and ensuring that every cent within his institution was tracked and documented correctly. He knows how money works. He respects money. He has always respected money. 3 years back, when Gerald stepped away from his career, he did what many cautious individuals tend to do. He took the retirement funds he had spent 3 decades carefully building, and he deposited them into his bank, his neighbourhood bank, the one he had trusted for over 2 decades, the place where the staff recognised him by face. He placed everything into one account because it felt secure, because it was comfortable, because no one had ever suggested there was any reason to think twice. Last year, Gerald received a notice, not directly from any government agency, but from his bank, informing him that they had submitted a federal report concerning his account, a report that had caused his account to be flagged for review by federal financial oversight authorities. Not because he had broken any laws, not because a single dollar in his account had questionable origins, but because the way his funds were sitting in that account and the manner in which he had been moving money, transactions that seemed completely ordinary from his point of view, had set off automatic federal reporting requirements that Gerald had never once heard of. Gerald reached out to me. He was not furious. He was in a state far more troubling than fury. He was scared. He told me, "I gave 33 years of my life to earn this money. I followed every rule. How is it possible that following every rule got my account flagged?" I spent nearly 45 minutes on that call, walking Gerald through 5 specific regulations governing bank accounts, and IRS reporting that most retirees have never been made aware of. Regulations that are on the books right now. Regulations that are actively being enforced right now. Regulations that determine when your bank is legally required to submit reports about your account to the federal government, without your knowledge, without your permission, and without any requirement to notify you before they act. By the time that conversation ended, Gerald fully understood what had taken place. And more importantly, he knew precisely what steps to take going forward to ensure that it would never happen to him again. In this video, I'm going to share with you everything I shared with Gerald. The 5 things every retiree needs to understand about how much money to keep in a bank account, what sets off automatic federal reporting, and what you can do starting today to safeguard yourself and your life savings. This is not about concealing money. This is not about dodging taxes that you rightfully owe. This is about understanding the rules of the system your money is already living inside. Rules the bank will not voluntarily walk you through. And rules the IRS is certainly not going to mail you a helpful summary about. Stay with me. Before I get into those 5 rules, I want to establish something important, because this subject attracts a great deal of misinformation online, and I want to be absolutely certain that everything I tell you is rooted in actual law. The rules I'm about to explain are not hearsay. They are not speculation or fringe theories. They are documented federal statutes and IRS regulations that have been active for many decades. Some of them you may have encountered in pieces: the $10,000 rule, the structuring statute, FDIC coverage limits. But having only fragments of information is dangerous when it is the full picture that actually keeps you protected. Here is the broader problem that hits retirees especially hard. Most seniors accumulated their savings during a time when banking regulations were more straightforward, when the connection between a person and their financial institution was clearer and less complicated, when keeping a substantial sum of money in a single community bank account was the obvious, sensible, and responsible approach. The regulatory environment has changed considerably since those days. Federal reporting obligations have grown broader. Digital surveillance of financial activity has intensified. The trigger points that cause automatic federal reports to be generated have not been updated to reflect inflation in decades. That means amounts of money that would have been viewed as modest savings 4 decades ago now sit well above the reporting thresholds that were established when those thresholds were originally written into law. And here is the particular danger zone for seniors. Retirees are frequently moving money in ways that are entirely normal for their stage of life, taking required distributions from retirement accounts, receiving monthly social security payments, handling the proceeds from an inheritance, combining accounts following the passing of a spouse, covering major expenses like home renovations or medical devices. These are completely above-board transactions. They have perfectly straightforward explanations, but several of them can, without the right framework and awareness, trigger federal reporting obligations that paint the picture of a pattern the IRS, or FinCEN, the Financial Crimes Enforcement Network, is specifically trained to examine more carefully. Gerald's experience was not a rare one. I encounter variations of it on a regular basis, and every single time, the person at the centre of the situation is someone who did absolutely everything right with their finances, but had no knowledge of the reporting system their money was operating within. You are about to know those rules if you want financial and legal information that shields your savings before you ever find yourself in a difficult position. Hit the subscribe button right now and turn on the notification bell. This channel exists precisely for that purpose. Now the 5 rules. Rule number 1, the $10,000 cash transaction reporting requirement. Let me begin here because this is the rule that most people have at least heard mentioned, and also the one that is most frequently misunderstood in ways that create genuine problems. Under the Bank Secrecy Act, a federal law that has been on the books since 1970, any cash transaction of $10,000 or more must be reported by the financial institution to the federal government using what is known as a Currency Transaction Report, or CTR. This is automatic. It is mandatory. The bank has no choice about whether to submit it, and you do not need to have done anything improper for that report to be generated. Here is the first thing that most people miss about this rule. The $10,000 threshold applies specifically to cash, physical paper currency, not to checks, wire transfers, or digital payments. If you deposit a $10,000 check, no CTR is filed. If you deposit $10,000 in physical cash, one is. That distinction is critical. Here is the second thing most people do not understand, and this is precisely the element that caught Gerald off guard. The CTR is not itself a red flag. Banks submit millions of them annually, and the overwhelming majority lead to absolutely no action of any kind. What transforms a CTR from a standard filing into something that draws heightened scrutiny is when it shows up alongside other behavioural patterns. Which brings me directly to rule number 2, a quick note on what you should do if you ever need to deposit or withdraw more than $10,000 in cash. Go ahead and do it. Do not avoid it or divide it into smaller pieces to stay beneath the threshold. The deliberate act of splitting transactions to avoid triggering the $10,000 reporting requirement is itself a federal offence, regardless of whether the money behind those transactions is completely clean. More on this in rule number 2. Rule number 2, the structuring law that ensnares innocent people. This is the rule that most directly accounts for what happened to Gerald, and it is the rule responsible for the most genuinely unjust outcomes involving innocent, law-abiding individuals, including a considerable number of seniors in recent years. The federal structuring statute, codified at 31 U.S.C. Section 5324, makes it a federal offence to break financial transactions into smaller pieces specifically to prevent triggering the $10,000 CTR reporting requirement. At first glance, that sounds perfectly reasonable. Deliberately concealing large cash movements should be against the law. Here is the problem. The law does not require the government to demonstrate that you knew the reporting threshold existed. It does not require the government to show that your money came from an illegitimate source. It does not require the government to prove that you intended to evade taxes or carry out any other crime. Under the structuring statute as it has been enforced, and the Supreme Court has engaged with this issue in ways that remain subject to debate, the government can pursue a structuring case based solely on the pattern of transactions, regardless of the perfectly innocent reasoning behind them. The IRS and FinCEN operate pattern recognition systems that are specifically designed to flag what they call sub-threshold structuring, a sequence of deposits or withdrawals that each fall just below $10,000, arranged in a pattern suggesting deliberate avoidance of the reporting trigger. Seniors are especially at risk because of completely innocent habits. A retiree who receives a substantial insurance payout and deposits it in several installments because placing an enormous sum at once makes them uncomfortable. A retiree who makes ongoing cash withdrawals to pay home repair contractors in cash, because that is the payment method those workers prefer. A retiree who moves savings from multiple accounts over the span of several weeks in amounts below $10,000 because they prefer to proceed cautiously and methodically. Every one of these patterns can generate a structuring inquiry. Not because the money has any criminal connection, not because there is any wrongful intent, simply because the pattern matches a recognized profile. What you should do: deposit and withdraw funds in amounts that naturally correspond to your actual financial circumstances. Do not artificially adjust transaction sizes based on what you imagine the bank might be watching for. If you have a significant amount to deposit, do it in one transaction. A CTR will be filed, and that is perfectly acceptable. What is not acceptable, and what creates genuine legal exposure, is a pattern of transactions that appears engineered to remain below the reporting threshold. Rule number 3. The FDIC insurance limit you may already be exceeding. This rule is distinct from the first two. It has nothing to do with government reporting. It is about protecting your money from something most retirees have not thought seriously about since the financial collapse of 2008. FDIC insurance, provided by the Federal Deposit Insurance Corporation, covers bank deposits up to $250,000 per depositor, per bank, per account ownership category. That means if your bank collapses, the FDIC will make you whole up to that ceiling. Here is the problem. Many retirees, particularly those who have consolidated assets after leaving the workforce, after losing a spouse, or after receiving inheritance funds, carry balances that surpass $250,000 within a single institution. And the vast majority of them have no idea that everything above $250,000 is entirely unprotected. If that bank fails, an event that feels unlikely until it actually occurs, and one that has occurred multiple times in recent memory, the funds above the FDIC ceiling are not guaranteed. They enter the general pool of the bank's remaining assets. You become an unsecured creditor, and recovering those funds is far from certain. For seniors living on fixed incomes who cannot absorb the loss of a significant portion of their savings, this is not a hypothetical concern. It is a real and entirely manageable one, once you understand how the coverage works. What you should do: add up your total deposits at every bank you use. If any single institution holds more than $250,000 in your name, consider moving the surplus to a different bank or placing it in a different account ownership category, such as a joint account held with a spouse, which carries its own separate $250,000 coverage limit, to bring each insured category beneath the protection ceiling. This is not complicated. It is not a tax maneuver. It is simply understanding how the insurance designed to protect your money actually functions. Rule number 4, the 1099-INT reporting threshold and what it means for interest earned on savings. This rule is the quietest one on the list. It triggers no enforcement actions. It creates no legal exposure for people doing nothing wrong. But it costs retirees real money every year. Actual dollars lost, in the form of taxes they could have planned for and anticipated had they known this rule existed. Every financial institution is required by the IRS to issue a Form 1099-INT to any account holder who earns $10 or more in interest over the course of a calendar year. That form is submitted to both you and the IRS simultaneously. The interest documented on it is treated as taxable income, ordinary income, taxed at your applicable marginal rate, added on top of your Social Security benefits, your pension distributions, and any other income streams you receive. For retirees who are carefully managing their overall tax exposure, particularly those for whom additional income can trigger increased Medicare premium surcharges through IRMAA, or push a greater portion of their Social Security benefits into taxable territory. Interest income from savings accounts is not a minor background detail. It is an active variable that needs deliberate management. Here is the specific concern right now. Interest rates on savings products are substantially higher than they were 3 to 5 years ago. A retiree holding $200,000 in a high-yield savings account earning 4% annually is generating $8,000 in interest income each year. $8,000 that is fully taxable. $8,000 that may push total income above a threshold that activates higher Medicare premium costs. $8,000 that the vast majority of people never factored in when organising their income picture for the year. What you should do: get clear on exactly how much interest your accounts are producing. Determine whether that interest is affecting your effective tax rate or your Medicare premium calculations, and consider, with the guidance of a qualified CPA or financial advisor, Whether tax-advantaged alternatives for some portion of your savings make sense given your particular circumstances. The 1099-INT will show up in your mailbox whether you are prepared for it or not. Being prepared is entirely within your control. Rule number 5. The suspicious activity report you will never know was filed. This is the rule that completes the full picture, and the one that most directly explains how a bank can submit a federal report about your account without ever notifying you that it has done so. In addition to the mandatory CTR for cash transactions above $10,000, banks have both the authority and, in many cases, the legal obligation to file what is called a suspicious activity report, or SAR, with FinCEN whenever they identify activity they believe may involve potential money laundering, structuring behaviour, fraud, or other financial offences. Here is what makes the SAR fundamentally different from the CTR. A CTR is generated automatically based on a dollar amount. You are aware of the threshold, the bank discloses it, it is transparent. A SAR is generated based on the bank's internal assessment of the nature of the activity. There is no specific dollar trigger, there is no automatic mechanism. It results from a review conducted by internal compliance personnel. And here is the part most people never find out. Federal law forbids the bank from informing you that a SAR has been submitted regarding your account. They are legally prohibited from disclosing it to you. The report is transmitted to FinCEN. FinCEN shares it with relevant law enforcement agencies, and you have no awareness whatsoever that any of this has taken place. What kinds of activity can set off a SAR? Transaction patterns that are inconsistent with a customer's known financial background. Sudden significant increases in account balances without a clear explanation on file. Repeated cash transactions without obvious justification. Activity that appears to serve no recognizable financial purpose. Substantial account movement that does not align with the customer's documented occupation or income level. For seniors who may be receiving inheritance funds, insurance claim proceeds from the sale of a home, or consolidating multiple accounts following a major life transition, these patterns can easily appear in their accounts through entirely innocent activity. What you should do, be ready to explain meaningful shifts in your financial behaviour if a bank compliance representative ever reaches out to you. Maintain records of significant financial events, the sale of a property, receipt of inheritance funds, insurance settlement proceeds, so that if questions ever surface, you have a clear paper trail that establishes the origin of the funds without ambiguity. And if you ever receive a call or written communication from your bank asking you to account for specific transactions, consult a financial attorney before you say anything in response. You have done nothing wrong, but having the documentation to demonstrate that fact clearly and immediately is what truly protects you. Let me bring all 5 rules together one final time. The $10,000 cash reporting rule. Deposits and withdrawals of $10,000 or more in physical currency trigger automatic federal filings. It is routine. It is not inherently problematic. Do not go out of your way to avoid it. The structuring law. Deliberately breaking transactions into smaller amounts to remain beneath the reporting threshold is a federal crime, regardless of whether the underlying funds are entirely legitimate. Make deposits in natural amounts that reflect your genuine financial activity. The FDIC insurance limit, $250,000 per depositor, per institution, per account ownership category. If your balance exceeds that ceiling, the amount above it is uninsured. Distribute your funds accordingly. The 1099-INT reporting threshold. $10 or more in interest income is reported to both you and the IRS. In the current higher interest rate environment, this income is meaningful and fully taxable. Know your number before tax season arrives. And the suspicious activity report. Your bank can submit a federal filing about your account without informing you, based purely on observed activity patterns. Keep thorough documentation of major financial events and be ready to explain them in clear, supported terms. 5 rules, every one of them grounded in real law. Every one of them being applied to seniors across this country right now, and not a single one of them explained when you walked into your bank and opened your account. Gerald reorganised his financial situation within a month of our conversation. He spread his savings across multiple institutions to remain within FDIC coverage limits. He established a simple documentation system for tracking any large financial transactions. He sat down with his CPA to address the interest income he had never anticipated, and he has experienced no further issues since making those changes. He called me 6 months later and said, "I wish someone had told me all of this 30 years ago." You are being told right now. Share this with every retiree you know who keeps substantial savings in a bank account. Share it with your adult children. Share it with anyone who is managing finances on behalf of an aging parent. Because these rules apply whether you are aware of them or not, and the bank is not going to walk you through any of them at the teller window. What happens if you believe your bank has submitted an inaccurate or unwarranted suspicious activity report that is now interfering with your ability to conduct routine banking? Check out the next video, where I walk through exactly what rights you have when a bank flags your account and the specific actions you can take to defend yourself and protect your continued access to your own money. I will see you over there.